Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is John Azar. Thanks for being on the show, John.
Thank you so much. I appreciate you having me.
Yeah, I'm glad to have you on the show and somebody that's been in the business and very experienced. I'm looking forward to this conversation with you and learning from you. But a little about John. He is the Executive Vice President of MACC Venture Partners, where he oversees capital structure, alternative financing, and investor portfolio development. Previously, was a co-founder and managing partner of Boston Venture Partners, a private equity consulting and finance firm based in Boston, specializing in real estate development and structured finance. Through his tenure, he worked on a cumulative portfolio of $1.8 billion spanning from Boston to Miami, as well as London and South America. So, John, thank you again for your time. I look forward to this conversation. But give the listeners and myself a little more about maybe your background in real estate and how you got into this syndication business.
Thank you. I came into real estate really as almost a pure chance. I got my start in the industry in the equity market with Morgan Stanley, and I was on that side of the business for a while. I worked for shops like that and Royal Bank of Canada Capital Markets Group. And from that, I walked away with a couple of partners with me who formed Boston Venture Partners, the firm that you mentioned earlier. And we did structured finance because our clients that we took with us, that's what they wanted to do. That's the kind of the projects that they wanted us to work on. We were pretty much almost like investment bankers or consultants as investment bankers for large-scale mixed-use deals that are in New York, Philadelphia, Boston. And I ended up working on that until about 2007, 2008. And for some reason in that time frame, the real estate business was not that good. Your listeners and you can probably guess why in that time frame the real estate business changed. So it was the start of the Great Recession, obviously, or the recent recession, and right. Our business disappeared overnight. We had to close shop for the most part. Me and my partners had to go back and get day jobs. We had to. It was a significant loss at that time. But around the same time, my brother who was the CEO of MACC Venture Partners, was launching the company, the previous iteration of this current company that I'm in right now, and starting in multifamily in 2007, 2008. So right around the same time frame as I was tanking, he was starting to take off a new firm. So and in around 2013, 2014, we decided to join forces, and I moved from Boston to North Carolina and joined him in growing the company.
Nice. Okay. So tell us about maybe a little bit about your team now and what your role is in your all's company now. I know we read your bio, but give us more details.
Yeah. Our team. I focus. So MACC Venture Partners, our company is a vertically integrated sponsor or owner operator. So what that means is that we own our own property management company. We manage our own assets in-house. And we also obviously have our acquisition and capital arms. I sit more on the acquisition and capital arms side of the business rather than the property side of the business, property management side of the business. The property side of the business, our sister company is called Capstone Multifamily Group. A little bit of a delta of other assets that are not owned by us. And the reason is that we may have sold some assets and we retained the management of the assets, but not the ownership of the assets. So there's a delta of about maybe 700 or 800 units that they manage more than what we own. We own around 6,000 units, and they manage close to 7,000 units, or Capstone manages 7,000 units.
Okay, that's quite a portfolio. That's great. And tell me, what was key in scaling to 6,000 units? Now, a lot of listeners would dreaming or drooling, thinking about having 6,000 units under management. And what was key in your all's operations, you think, in getting to that level?
Well, I mean, it's the old adage of Rome doesn't get built overnight. I mean, that's really that's really it. A lot of that growth happened in the past 3 to 4 years, 5 years. The first, we've been in business since 2007. So, so I'd say the first 5 or 6 years, 7 years, we had to get to a somewhat of a critical mass of about 2,000 units or so, 2,500 units. And then from about 2014 to now, we added an extra 4,000 units. So, I mean, sometimes companies take them. The hardest thing about any company, not just in real estate, is obviously the first year or 2 years or 4 years of the company's life cycle. Mm-hmm. That's when you're starting to get your deals underneath you. That's when you're starting to get your reputation. That's when you're starting to get your first investor, especially in the real estate industry. You're starting to get sort of your own credo under your lenders. You're starting to get to know lenders. Lenders are trying to get to know you. Really, that's the hardest part of our business. I mean, the hardest part of our business is not just the knowledge, but the actual whereabouts to actually execute deals. And that whereabouts of executing deals, you obviously have to have the lending piece lined up and the equity piece lined up. And really that's the stumbling block in our business, or rather the holdout is that you have to make sure that your debt is lined up, and your debt doesn't line up unless it's kind of like the chicken before the egg. Like a lot of lenders want you to have the right amount of net worth and the right amount of equity and a lot amount of liquidity. But you can't get those things until you start doing deals. So,
right.
So it's very difficult in the beginning to execute deals if you're coming right out of the gates, because you got it. It's a fine balance between trying to have your credibility in place mm-hmm. while trying to launch a deal. It's really difficult. It's a difficult balance because a lot of the initial money, a lot of the initial capital, when you first start doing deals, have to come out of your own pocket or family and friends. You have to sort of right. cobble together some money and somehow or another find a lender that will lend to you, and hopefully the next deal will be easier, and the deal after that will be easier, and the deal after that will be easier. And so really that's it. It's just kind of, you just have to keep at it, grow it slowly. You can't eat a whale all at one sitting. You eat a whale one bite at a time. So it takes a while, and it takes some patience, and it takes a good amount of diligence and being vigilant about protecting your reputation in the marketplace, because I tell you what, it doesn't take much to sully your reputation. And once your reputation is sullied, especially among lenders and equity partners, it's very, very difficult to make it back up.
Yeah. So, what are some, maybe a couple of systems that you all have in place that are like, as a new syndicator that's listening, that okay, this is something that is crucial that maybe you didn't know initially to have in place?
So I think the simplest answer would be, you have to know your value and what you bring to the table. A lot of people sometimes underestimate their own value if you've had, and they let fear control the equation, and that shouldn't be the case, because a lot of times people get overwhelmed by sometimes the size of an acquisition that they're trying to take on, and they look at a 20 or 30 or 50 unit complex, and they think, oh my goodness, how am I going to be able to take that on? And I don't, I've only done two quadplex or triplex or something like that, and that's the only thing I have under my belt. Well, if you've done that, you probably have more under your belt than some other people. Maybe you have less than other people, but you also you may have more than other people. Also, don't underestimate your circle of influence, or circle of friends, family, and anybody who may be able to help. And they're not just helping for they are going to be helping for your own, obviously, reputation with them and your own connection with them, but they're also going to be hopefully getting something out of it. If you do enough of a good job in your due diligence and your financials, you'll be able to pay them back, and they'll be able to be they'll be very happy with the investment with you. So I think if I was to redo something over again, I would probably widen my sphere of influence and probably be a little bit more daring on the kind of investments I would do. And first and foremost, I would probably get into this business a lot earlier than what I got into this business. And I think my brother Tony would tell you the same exact thing, and that we both wish that we probably got into this business maybe a decade earlier than when we got into it.
Most of us would say that, I think, like I wish we'd have got in 10 years earlier.
Of course.
For sure. So, what about, you've been doing this for a good while now, and I was thinking about, the people listening, and they're either aspiring syndicators or they're passive investors, but I'd love, like your guidance or your wisdom for somebody that's just getting started, anything that's crucial as far as on the operator side. And then I'll ask you as well on the limited partner side, but specifically for the operator, maybe just a couple words of wisdom from your experience, just things they should be focusing on, other than and I liked what you said there. You can't let fear control the situation, but maybe you could speak a little more to them.
Well, yeah, I mean, on the same token of don't let fear control the situation, also don't be too daring and too optimistic on your numbers. You got to also be realistic and in your due diligence. You got to be, we all want best case scenario, but you don't underwrite your performance to best case scenario. Underwrite your performance to worst case scenario. So always when you look at the numbers from a worst case scenario standpoint, not from a best case scenario standpoint. Everybody wants to see the rosy picture. Everybody wants to get those $200-300 rent bumps, in a new acquisition that you take on. Is it always possible? Heck no. That's not going to happen. So you look at something, be very, very careful on how you underwrite. Your underwriting is crucial to the deal, because I tell you what, you make your money when you first get into the deal, not when you sell it. And that's something that my brother believed in from the get-go. You always make your money from day one of the deal, not from the last day of the deal. If you get into a deal that you get into it correctly, and your numbers are correct, and your due diligence is correct, and you underwrite very conservatively, then you outperform, then everybody's happy. If you underwrite aggressively and you underperform, nobody's going to be happy. Right. Not yourself and not your investors. So I would say just look at your due diligence in any acquisitions as a sponsor and as a syndicator is crucial to winning or to really having a successful deal.
How's the best way for them to really learn some good underwriting practices like that? I mean, I know, like when you're first getting started, you're trying to put all the information in, maybe to some kind of template or something like that you found online. You're trying to learn how to underwrite, but you're still always that question. Did I put in the right assumptions? Did I do this correctly? And how do you advise really getting better and perfecting if you can perfect it? Getting as good as possible at that underwriting side of the business.
Ask as much as you can. I mean, there's no shame in asking. There's no shame in getting guidance from other people who have done it or have done it longer than you, or have done it, and bigger than you, or in different markets. Be connected to the industry. It's your industry. Be connected to it. Go to different conferences. If you can't afford to go to conferences, go to local events. Go to meetups. There are a ton of meetups around in different various cities that. Most of them don't cost anything to attend. Most of them, you just have to go to the meetup and sign up to them. And a lot of the smaller syndicators and people that are just starting out in the business, and a lot of them are coming sometimes from single family flips. A lot of them came from, they used to do a lot of single family homes and renovate and flip, or renovate and hold, and they're trying to break into the business. A lot of them have their own models, and I see sort of that synergy of exchanging different information. And obviously, as you continue to grow, your sphere of influence will continue to grow with you, hopefully. So you can then at some point you can afford to travel and maybe attend conferences, and then at those conferences, hopefully you'll meet people like you who have their own models, and say, hey, just out of curiosity, what kind of model are you guys using? And here's my model. Is this something? Is this something that makes sense to you? And if it doesn't, are you using a better model? Do you mind sharing it with me? Don't ever be afraid to share, first and before you get. And if you don't get anything, it's fine, but continue to share. People are always, I think the biggest hang up I see with people is they're always so protective about stuff. This industry, the more you share, the more successful you'll be. It's counterintuitive to any other
Right.
industries.
Right.
You know, if you share more, you'll be more successful. You know, hoarding information doesn't really help you or you know, help extend your influence or help you win more deals. It's the
Right.
exact opposite. The more you share, the more you'll be, your reputation will grow better in the industry. You'll get introduced to more people. You'll meet more people. You'll access more information, and more information will be available to you. So always don't ever be afraid to share, and don't ever be afraid to ask. Also, you know, you meet somebody who's you know, somebody bigger than you, or somebody who's, you know, in the same circle or different circles than you. Say, hey, you know, I'm just curious. Can you share? They may say no. They may say, look, I'm sorry, I can't share my underwriting with you because it's proprietary. Okay, I understand. Can you look at my underwriting and tell me if I'm on the right track or not? That's it.
Yeah.
You know, and just say, okay, if you can't share my underwriting, what are some practices that you use in your underwriting? What kind of numbers do you look at? You know, what kind of percentage expenses do you look at? What do you project out when you're looking at marketing expenses? You know, rent increases. You know, what are you using for roofing? What are you using for, you know, what kind of numbers do you average when you look at, you know, repaving a parking lot? I mean, you know, you can get down as granular as you want, you know, and
Right.
and if somebody says no and they don't want to share it, that's fine. It's a no. Who cares? You know, at least you asked.
John, what's your all's buying criteria?
So we're in the workforce housing. We're in value add. We buy mostly B class, B minus, B plus. Every now and then, recently, because of where the market is and the disconnection in the market, we've started to buy more upstream. So we've started to buy more A class and A minus class, and look at buying those type of assets that we have not looked at previously, just because of the market pricing. It's such a small disparity between, sometimes when you look at an A class project and a B class project, it makes no sense for you not to go upstream sometimes and just buy that newer project, because, you know, if you're looking at something that's a 5.5 cap rate and it's a 1980 construction, and you look at something that's 5.25 cap rate and it's 2010 construction, I would much rather, you know, pay up the extra quarter, 25 bips cap rate, and buy something that's 25 years newer, because you're saving on your physical obsolescence of the units, and you're going to make it on the back end anyway. So that's why we moved upstream. So that's our buying criteria, is that we ideally would like to still buy something that we have some value injection in, some kind of either through physical value add or through operational value add. So you can there's two ways you can do value add. And if you buy something that's newer, sometimes it's and have a full renovation, maybe it's an operational value add. Maybe the management is not right. Maybe the you know, their selection of people is just off, or maybe they didn't decide to charge for certain things, and that's going to work to your advantage. Obviously, the physical value add is the most obvious. If you buy something that's completely non-renovated, we'd like to get into a situation where we're renovating anywhere between the tune of $2,500 and about $6,000 or $7,000 a unit. That's our sweet spot.
Nice. What's your best source for finding deals right now?
Oh my goodness! Everybody and everything. I mean, you know, if I could use my son's sixth grade teacher to help me find deals, then I will. I mean, you know, we're using everybody to find us deal. We're using brokers, obviously commercial brokers. They're one major stop for us to find deal, but we're using previous sellers that we've dealt with. We're using banks that we've dealt with, lenders that we've dealt with. We are asking our equity partners, our equity providers sometimes, because we deal with private equity companies, some institutionals every now and then. We ask them to give us some guidance on deals. We're asking everybody.
Okay, so here's the simple truth. If you don't have private investors waiting on the sidelines right now, you're going to have a hard time closing your next syndication. Are you afraid to talk to investors? Do you feel you have a lack of credibility, or no one will take you seriously? Or what about your systems? Do you have anything set up yet? Well, if you know you can improve on getting in front of and influencing passive investors, then you should call my friend Adam Adams. Adam has a proven system for you to flip the script. Now, this is a 5-figure investment for you to take your business to the next level. I want to see you succeed, so I placed a link in the show notes for you to apply to work with the Adam Adams. And if you think you qualify, and you know you're going to take action on what he teaches you, then scroll down, find the link, and take your money-raising abilities to the next level. Nice. And, John, what's been the hardest part of the syndication process or business for you?
Yeah, for me personally is probably to get my arms around all the different moving parts of the syndication and the due diligence process, and what things, the lens that I need to look at the numbers, because the way that you look at numbers from different industry and from a different, so before I was in multifamily, as you have mentioned initially, and when we first started the podcast, is I was in structured finance for large scale mixed use development. The development world, and especially large scale development world in different major cities like Boston or New York, is completely different numbers, the way that you look at numbers, than doing multifamily in Knoxville, Tennessee, or multifamily deal in Roanoke, Virginia, or in Charlotte, North Carolina. So, you're not looking in the same, you're not even using the same lens to look at the deal. So the hardest part for me, I think, was to get used to these numbers and to look at the numbers and have a critical eye for things that are going to be very pivotal to the deal itself and will change the numbers significantly, that I didn't know about. And that was what are things to look at when you look at apartment complex? I mean, should you look at piping? What kind of piping should you look at? Is that kind of piping better than other type of piping?
Right.
If you're going to look at roofings, what do you think an average roof should be? What kind of roof should you use? If you're looking at the parking lot, what should you use? What kind of things can you add on to bring more revenue? Revenue drivers are a huge thing to kind of be aware and have a knowledge of, because there are a few revenue drivers that may not seem like much, but when you add them all together, they form a pretty significant chunk of your balance sheet.
So, how are you all prepared for the next potential downturn that everybody's talking about?
Well, when is it coming?
Well, let me get my calendar out.
Yeah. Can you get the calendar out and let me know when it's coming exactly? Because I like to pencil that in on my outlook. Look, man, we've been in a cycle that everybody's is expecting to change for the past 5 years. I think since I moved here from Boston 5 or 6 years ago, everybody keeps talking about we're in the 7th inning, we're in the 9th inning, we're in the 8th inning. I mean, my goodness, this is looking like the longest baseball game ever played in the history of real estate. So I don't want to hear anything about innings anymore, because we've blown through any innings that we could possibly have gone through at this point, and we're going way overtime. The way I see it, we are way due for a correction. Yeah. Is it coming this year? I don't think so. I don't think it's, we are in an election cycle right now, realistically, between now and November. And typically, historically, during election cycles, the economy tends to do better than worse. So I don't think we're looking at a worsening scenario as far as the economy is concerned. So as long as the economy keeps dancing the way it has been, we're going to continue to probably see similar numbers on interest rates, similar numbers on growth, similar numbers on economic development. And it depends what happens during the election cycle. If we maintain the current administration, then we'll probably see continued growth. If we don't maintain the current administration, then you're probably going to see some kind of a correction of some sort. So, and this is a completely bipartisan opinion. It doesn't matter who's in office. Sure. This is just factual. If you go back the past 50, 60, 70 years and look at sort of election cycles and what happened during election cycles, you'll find out that's usually typically what takes place. During an election cycle, election year, economy does really well. If the administration prior stays in office, the administration continues to do well for probably another year after that. And if the administration changes, then there's an adjustment period in the economy. And we're looking at the same thing. So if we use those projections, and everybody I've talked to recently, thinks that nothing's changing in the next at least 12 to 16 months or so. I mean, we're going to be probably in somewhat of a holding pattern, status quo, for a while. I just came from NMHC, one of the largest shows in our industry in Orlando, and talked to a bunch of people at NMHC, and they are all projecting the same thing. I mean, we're going to be in a holding pattern or pretty similar pattern between now and the next 12 months. And then after that, something is bound to happen, whether interest rates start to rise up, debt start to be a significant part of a disruption in the economy.
Mm-hmm.
And when I say debt, I'm not talking about real estate debt necessarily. I'm talking about consumer debt, credit card debt. Consumer debt and credit card debt are really two sleeping giants right now that are going to be pretty effective moving forward if they're not addressed. So we'll see.
Yeah.
I don't know if that answers your question, but it's
good. Well, whatever. Yeah. I just like to hear different people's opinions about, how they're planning for that or the potential downturn that everybody's talking about. But, John, what's a way that you all have recently improved your business that we could apply to ours?
So, every operator or syndicator is going to go through, every company really are going to go through their own growth phases, and inflection points, called inflection points. So, and you approach your company structure and the way you do business based on those inflection points that you reach. In our business, I think certain inflection points happen in certain stages of your growth. In the multifamily business, once you get to about 1,000, 1,500 units, then, you hit your first inflection point and you start to think, maybe I should bring property management in-house. And that's usually around the time when you should start to bring property management in-house. You hit about, 2,000, 2,500 units or so, you reach a different inflection point. And then you have to start thinking about, how should I structure my equity? Should I, what does the capital stack starts to look like? Do I need to start looking into different type of equity? So around 2,500 units, 3,000 units, that's when we started changing our complete, capital stack and start going after more sophisticated investors, more private equity, more institutional, start talking to more institutional guys. Again, around 5,000 units is a different inflection point, and you have to start talking about changing your interior structure and even the interior roles that you have for people inside the organization. And what does that look like? Maybe if you had a controller, maybe that controller now becomes a CFO. I know it sounds like semantics, but it's really not. It's, a CFO's job is different than a controller's job.
Right.
You may still have a controller in-house, but you hire a CFO to do something completely different than what a controller would do. Maybe you hire an operation manager, maybe you hire COO. Your acquisition team starts to kind of take different shape. You hire more underwriters or more analysts, and I would say be aware of where your business is and where your growth is. And ask also, ask your sources. Your sources of equity are probably the best people to ask. What do you need to see? What would you like to see in a company like ours? I know you like us. I know you love us. I know you want to give us money. But in an ideal universe, how would you like us to look like as a company? And you'll get, you may be surprised. You may not be surprised at the answers you get. But those are usually the best people to go to and say, hey, what do you like to see in people like me? What kind of company structure? What type of internal structure, operations should look like for you, and go from there. Because what got you from point A to point B is not necessarily the same thing as going to get you from point B to point C.
Great advice. No, that's great advice, John. And just a few last quick questions before we run out of time. But what's the way that you all are finding investors right now?
Through network, aggressively networking and using our wide network of people we know. And our network, obviously, in the stage we are right now, our network is a lot wider net than people who are just starting out in industry. As I mentioned earlier, people who are starting in industry, your network is, it starts out at a very small circle, and you kind of widen it as you grow bigger and bigger. Our investors right now, it depends on the size of the deal. If it's a really small deal, we sometimes rely on just our own fund, that's internal fund, and our own investors, like accredited investors, high net worth investors who have been with us for the past 12 years and will continue to invest with us. If the deal size grows beyond, let's call it 4, 5, 6 million up to about 9 million, we companies that we're partnering up with, and sometimes use a combination. And if the deal is over 9 or 10 million, then it's usually institutional grade trade investment at that point, and we go to an institutional shop. They
Okay.
can pretty much write a check for, 80-90% of what we need, as opposed to going to 50 people
Right.
to attain the same amount.
What's a way that
everywhere.
you all stand out as far as in your relationship with your investors?
So I think the easiest way to answer that is, and I know it sounds maybe too good to be true, is we've never lost money on any of our deals. The one thing that I can boast to any of our
That's a
investors,
plus.
that is a plus. That is a plus. We've not only have we not lost money on any deals, we've never not had to pay out investors. We've never had to do a capital call on any of our investors. We've never had to. And for those of you who don't know what that is essentially if you do a deal, you consummate a deal, you launch it, you're operating a deal, and a year down the road, you didn't account for a certain amount of numbers, and you have to go back into your investors and say, "Oh crap, I really need another $1 million into this deal," and you have to raise some more money, and that's a capital, and that's not a place that you want to be. That's not a place you want to be. And the reason we've avoided that, and that's maybe important for your listeners, the reason we've avoided having to do that in our history is because we always front load all our CapEx or capital expenditures from day one. A lot of syndicators and sponsors, sometimes what they do is they, instead of front loading their CapEx, they build their CapEx out of their operational budget. And I'm sorry to say it, that's the wrong way to do it, because then you're counting on, if God forbid something happened to your operation, something happened to your property, and you're not making enough money, then you're out of luck. You're not making enough you're not drawing out of your operations enough to meet your CapEx needs. So always front load your CapEx from day one. You know that you need $2 million for this property for the next 5 years. Front load that and raise it right up front, as opposed to trying to take it, from your operations in the next 5 years.
Great advice. I hope we can have you back soon and us dive into a little more of that and how you all have structured deals and some things like that. But a couple more questions. What's the number one thing that's contributed to your success, John?
I think probably the family's work ethics and family's belief in what how we should do and how we should grow our business. At the end of the day, our company is a family-run company, and through the integration of our different companies, we run it like a family. And my brother's the CEO, and we have my nieces are in the business, and so it's you have to have a very vigilant, strong work ethic to be able to get up in the morning and put your big boy pants on, no matter what happened the day before, and you continue to slog. So it's not easy. It's not an easy game. This is a very, very enjoyable world. I love being in this industry. It's not necessarily for everyone, but you got to love what you do, and you got to, when you love what you do and you get up and you do it over and over again, it's not even a job anymore.
And then tell us how you like to give back.
So I do a good amount of mentoring and coaching in all ranges. I coach people that are up and coming in the industry and younger syndicators, as opposed to as well as I do a lot of volunteering in organizations for young entrepreneurs and young adults that are coming out of high school. I have done a lot of volunteering when I was in Massachusetts, and a couple of various different organizations. There's an organization called Year Up that mentors young adults coming out of high school and finding them a job placement to do. I sit on a couple of different boards, so it's always empirical to find some way to give back. It's very, very rewarding, and you can give back in very small ways. That you don't have to wait until you have money to donate necessarily. It's not about writing a checkbook. It's not about opening your checkbook and writing big money. Right. It's really about more putting your passions, where you think your passions would do the biggest impact.
Wow. Well, thank you so much, John, for your time. It's been a pleasure to have you on the show, and I hope we can have you back, at some point in the future, and maybe even some more of your team members. But it's a pleasure to have you on, somebody with your level of experience in this business. But tell the listeners how they can get in touch with you and learn more about you.
Sure. Yeah. Thank you for having me. The best way to get a hold of me is my email, John, JOHN at MACCVP.com, MACCVP.com. Our website is www.maccvp.com. You can find me on Instagram under Jalal John Azar. You can find me on LinkedIn, obviously, also under Jalal John Azar. Jalal is my first name, John's my middle name. So any of those ways, hit me up, and would love to connect or answer or give advice to anybody.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.